Good morning. Welcome back to the Opportunistic Trader. We're joined by Tony Greer of TG Macro. Tony, how are you?
Good, Mike. Good morning. How are you?
I'm good. I'm good. We're just talking. We got the FOMC is the big event of the day, and want to get your thoughts there.
Yeah, I mean, it sounds like Fed Chair Powell is staying on this path of rate normalization. We're 100% going to get another 25 basis point rate hike today. The data supports it. We just saw consumer confidence come out at decade highs, and that's definitely a factor of the president's policies taking effect. Economy looks pretty strong. The market still looks good. The S&P just broke out, is trying to break out to a new high and keep grinding. Globally, we've got yields sort of reaching their high point for the move. And that's kind of what I've been expecting this year. I think it's telegraphing, not necessarily commodity inflation, but some inflation in other areas of the market, like trucking sector, and obvious healthcare inflation and things like that. So I feel like rates deserve to be higher, until the data starts weakening or something, or the city economic surprises index just comes crashing down in a string of terrible economic misses. It feels like it feels like the bond market will remain offered and we can keep grinding higher.
So you
In the
think the
short
path
term.
of least resistance is just yields to move higher, not necessarily a spike of any, it just, continue the general trend though?
Yeah, it feels like it. I mean, if you look at the 10-year in the US, we're finally, pounding away at that 310 top that we saw back in May. So I think that we're going to take that out finally, with you got moving averages rising up to meet interest rates now. And I think that, if you're a believer in the technicals and fundamentals, then you just stay with this story because it's panning out, kind of in a logical fashion for a change. So I can deal with the short bonds, short treasuries makes sense to me. Long crude oil makes sense to me. And the macro trading world is back. So I'm excited.
Yeah. So if that happens, is there certain sectors in the equity markets, like for instance, typically financials do better with rising interest rates? Do you get the sense that that's something? Are you looking at financials or anything to go along with that yield play?
No, I don't. I don't have a direct correlated play, to be honest with you, Mike. It's just kind of fitting into the general theme of higher rising rates, that I've been looking for in the market. So I'm just kind of playing things the way I see them in all different sectors. It still makes sense to me to be long energy stocks, to be long trucking stocks, to be long, rail stocks. It still makes sense to me to be short social media. Makes sense to me to be really short housing. Now with if you now that we've got 30-year yields pressing up against the top of the range, looking to potentially break out above 3.25. If that happens, you got a rising cost of capital for the new home buyer, and I feel like that can put an additional damper on the home builders. And I'm going to be smart this time and not just pick the sector ETF XHB, but I am going to dig into a few individual names like Pulte and Toll Brothers and decide which ones I want to short. I've got a small short on in Pulte Homes. Right now, it seems to be coming off kind of nicely, and that's just trying to trade with the market's given me, Mike.
Yeah, well, let's talk about this housing a little bit more because I actually just pulled up a chart of lumber, which is, typically pretty correlated with the housing market, and it's had a wild ride this year. It's basically moved from 300 up to about 600. Now we're back at 335, and lumber is down about 25% now on the year, and that's typically correlated with the housing market and a strong economy, things of that nature. Do you have any thoughts on lumber and how that might play into the housing market?
Yeah, lumber rallied really sharply, into sort of this summer, where where I would consider we had call it peak NAFTA woes over the summer. Not knowing how it's going to work out with our trade agreements with Canada after Mexico said, "We'll do whatever you want." So the lumber price, spiked into that, there being a big concern that there might be a U.S. tariff on Canadian lumber and the price was going to go berserk, et cetera. It's turning out not to be the case. The housing market is, the economic housing data is softening a little. And that caused, the lumber market to come off from, $60 per thousand square board foot to $33. So it's a major move, and what, in my opinion, that's a huge tell to me, because when I see lumber coming off like that hard, literally getting halved, I'm expecting there to be an incremental bump higher in the building sector, just like when the price of oil went down to $25, the airlines were roaring because their fuel costs were going down.
Right.
So I would have expected that with the builders. And since that didn't happen, it made me twice as bearish the building sector. So it's definitely, the lumber is a tell in that the stocks weren't able to benefit from this cheaper input cost. And to me, that's just bad news now with the cost of capital rising. So, it's just kind of showing, it's kind of panning out here, where the economic data that's sort of softening in the housing market is coming out in the tape. And I would imagine that the massive overperformance that we saw by the home builders in last year is going to turn into a massive underperformance in the next year or two. And that's how I'm playing it.
Yeah, well, I just brought up the charts of Toll Brothers and Pulte, and they really do look very bad. Look nothing like, the broader equity markets in the US, the S&P, NASDAQ, Russell. These things are near their lows, and even looking at a chart of Pulte, it's, getting close to more. I think this is a 52-week low here. And then actually just looking at today's data, so we just had a 10 o'clock new home sales come out, and the broader measure was actually in line at 629,000 roughly. But if you look at the details, I'm seeing here, median price was actually 320,000 versus the prior was 328,000. So that's a pretty big decline. And then monthly supply is up 6.1 versus prior 5.9. So, definitely some stress in the housing market.
Yeah, for sure, man. And those stocks are reflecting it. They are a great barometer of, the sum total of their input costs and the economic housing data. And so I really like to trade them, and I feel like I got them dead to rights at this point. I feel like they're still probably over owned, and there are people trying to get out as we speak. My target for Pulte Homes, now that you mention it, and I am sitting here short, is the February high of about 23 and a half. And I'm going to bid around there to cover part of my position and then see what happens, because I feel like Pulte can trade back to 20.
Yeah, well, it's definitely been a good short recently. It's right now, I have the weekly chart up, and in 2016, we were trading in the $15, $16 range. Then, had a nice move higher into the year 2017, and 2018 has not been good to the home builders.
Yeah, exactly. So what do you think about Nike post-report, Mike?
Yeah, let's bring that up. I know that that's been something that you've talked about. And, it's funny, that gets back to the way, people take a look at the equity market. So we made a new high, traded up last week above 86, and here we are trading below 83 right now. And that seems to be one of the hot topics. What are your thoughts?
Yeah, it makes for an interesting setup, because we've just had, we've had a rally in Nike from 50 to 85, since the fall of last year. So a 1 year rally that has been really right on track, and sort of along with their rebuilding story. And then, in my opinion, what may still turn out to be the top of it is they've got, they're hiring Colin Kaepernick as the face of their Just Do It campaign, which I continue to think is a lousy idea. And there are tons and tons of people way smarter than me that think it's a brilliant idea, i.e. Scott Galloway. And he's got a much better handle on the marketing aspect of it than I do. But I am still going to pay attention to the trade setup that now puts all of those post-Kaepernick Nike bulls under pressure. Because, they got a nice, easy ride where the stock never tested support during the story of them hiring a non-athlete as the face of their athletic clothing, thinking that's going to be a genius maneuver. And now everybody in the position is right back to where they started from, basically from where before they hired Colin Kaepernick. So it puts them in a little bit of a treacherous position now. They've got to decide whether they want to buy the dip and protect this Nike rally, or say, you know what, if we already had a dip in this quarter, if they're wrong and the Kaepernick decision turns out to be a bad idea and has a negative effect on sales, then you could see a real collapse and tremendous risk on the Nike long. So, I'm not saying it's going to play out that way, because Nike truthfully has not even really tested the uptrend since back in April. So we'll see. I want to try to let the stock do the talking. If it curls down below the 50-day moving average again, I might get short. Because you can always put the same short back out, the one that burned me after the headline. And it would not shock me to see a post-earnings waterfall in earning and Nike back into the moving averages somewhere between 77, 75, like that.
Do
So
you
we'll
happen to
see.
have the chart up now? Where do you see the 50-day moving average?
The 50-day is at $80.80 currently.
Right. And so that's actually pretty close to where it was before that. I guess it was about $82, pretty close to where we are right now when the initial Kaepernick news came out.
Yeah, it looks like that news was yeah, it looks like that news was yeah, exactly. It was right here. Before the news, it closed at 82.20. So we're, you're at a break-even price. There's been a lot of cheerleading, there's been a lot of positive commentary and actually positive stock response by Nike. And you almost wonder if it wasn't the right time to be feeding into that rally, with all of the sort of, I guess, liberal leaning money managers absolutely applauding the Colin Kaepernick decision. So, we'll see. The proof is going to come out in the guidance and in the numbers, and we'll see what happens. But, I'm not going to touch the stock again until it shows me that it can actually go down and break this trend and close below 80.80. And then I'll think about, tackling the Jaguar that's fallen out of the tree a little bit. But as of
Mhm.
now, the Jaguar is still healthy up in the tree, and there's nothing wrong with the uptrend. So it's just sort of a forward-looking trade, something to keep an eye on. Definitely not something that is, going to happen today.
Yeah.
But
So
we'll see.
sorry to jump back. I'm actually getting a question in, and I just wanted to ask you, getting back to the housing market, lumber and the home builders clearly in a huge downtrend. That kind of doesn't match with kind of the yields higher, global or U.S. economy stronger. Can it be that sort of thing where it continues? Because basically, you did start out by talking about the stronger economy and things continuing to be fine, but also being bearish to home builders. Can that dichotomy continue?
Absolutely, Mike. Absolutely. We can continue to see strong manufacturing data. We can continue to see a brilliant, employment market, which is fostering massive confidence. And we can see that building sector, absolutely come apart. This is a sort of a typical situation in what the modern bull market has been showing us, where it's totally possible for one sector like big tech to take up and absolutely run out ahead of the market. Then it's totally possible for another sector that's as simple and as basic as home building to sort of lag the market, especially when the cost of capital rises. You're going to have pushes and pulls in a vibrant economy, and there will be periods of, there'll be sectors of the economy that are seeing inflation and sectors of the economy that are seeing deflation, right? Like, our textbook costs and our healthcare costs are going berserk, but the cost of shipping things is falling into our lap.
Right.
So
Well, you
there
make
are,
a you make a really good point about the cost of capital. That is, we've seen that a good move in the 2 year and the 10 year. That's definitely the 30-year mortgage has definitely increased, so that definitely hurts the housing market. But typically, also though, if the economy is doing really well, people are making more money, they're more confident, and they go out and they want to buy a house. And we're not seeing that as much.
well, that's fine. They're going to have to pay a higher interest rate if they want to get it. If you ask me, with global yields all starting to lurch higher, and with the US 30-year yields finally participating in the rally. See, the reason that I'm really concerned about a continuation of the rise in 30-year yields in the long end is because the entire world is talking about the yield curve, right? The yield curve is collapsing because we've got front end rates rifling higher, the 2 year leading, the 10-year behind, and we've got the 30-year yields that are kind of lagging. The reason that I think 30-year yields are lagging is because 3.25 actually presents a pretty good yield to some of these pension funds that have been grossly underfunded. And I think that the bid in the 30-year paper is to absorb some of that 320 yield that they haven't seen in a long time. So if the pensions pull back on their bid in the 30-year and let the 30-year fall to the next level, then you could see a quick move up to 3.5%. And I don't want to still be long the home builders when the 30-year goes to 3.5. I want to be out of them. I want to be short them. I want to be looking to pounce and then take profits on a massive dislocation not sitting here holding the bag saying, hey, the economy's great and I don't care how much the cost of capital goes higher. I'm just going to be long builders. To me, that doesn't make any sense at all.
In a way, it actually almost makes sense of a healthy economy, not just from the perspective of, in 2008 we saw the housing market going bananas, and it was over excess, and in this it makes sense with higher yields, maybe
Right.
a paring back.
Yeah, you just defined it, right? We blew a bubble in 2008 because we had zero cost of capital, and then we had a massive fraudulent overlay on top of that, and a couple of different problems that contributed it. But yeah, the dirt cheap capital, and anybody being able to get a loan with no collateral was an obvious symptom of the housing prices just coming unglued and going to an unsustainable level. So
Yeah.
this is very much the opposite playing out, and I think it deserves for the home builders to be a radical underperformer in the next several quarters.
Yeah. So let's take a look at today, FOMC. Is there anything you're looking for from Powell or in the text that might lead you to make a trade in one direction or the other? Whether something that's leaning towards hawkish, dovish, what you might be doing?
I am going to continue. One of the things that I'm looking for, I guess, I kind of let the market speak to me and let the market react. I don't like to sort of predict what the market is going to do after an FOMC. I'd rather just sit back, let it happen, and then decide. One of the things that I am keen on critically is the gold market, because I'm sitting here short gold stocks. As rates have been rising, they have been a lot more attractive than owning precious metal that does not have any yield. So I'm looking for another rate rise to put another divot in the gold market and the gold metals and mining stocks. Now, if that doesn't happen, then I'll think about covering portions of my short, saying, wow, we just got another rate hike. We're seeing, steadily higher yields around the world. And for some reason, gold won't go down anymore. So if that's the case, I'll cover a little piece of my gold, a little piece of my gold shorts. But if we do get the rate hike and the yields continue to sort of tick higher and march higher the way they've been doing this week, I'm going to leave my gold short on and let it come to me, because I really think that at some point we're going to put all these gold bulls under pressure. And these gold bulls, meaning the ones that have been bullish at 1350, at 1300, at 1250, at 1200 and 1150, and they think that no matter what the price of gold is, that it's a good buy. And I think that's crazy too.
Yeah. Well, so you're basically saying we've been sitting here consolidating at 1,200 in gold, despite dollar yields, this and that, and so you're getting to the point where if we don't go lower with yields moving higher and a lot of correlations that typically work, that's something that you might take notice of and maybe take some profit if we don't go lower.
Yeah, and it's just giving me the opportunity to try to buy some stocks or gold back on weakness, and not have to go chasing them when others are buying them, So
Right.
it's really just it's a function of staying alive in the trade. It's a function of trading around a successful trade, and just kind of stay out ahead of it instead of getting run over being behind it.
Yeah, but your core thought is still you're short and you are looking for yields to move higher and gold to continue to stay under pressure.
Yes, sir. That
You
is
know?
the case.
Yep. Yep. All right. Well, good stuff. We have the FOMC at 2 o'clock. Hopefully, we'll get some good trading opportunities based off of that. But Tony, great information as always. That's Tony Greer, TG Macro. We appreciate you coming on with us.
Yeah, anytime, Mike. We'll talk to you soon. You
All
guys have a
right.
good day.
Talk to you later.
Later, pal.